chart types help us to identify trend in the market. So, it is essential to know how to read the chart. For understanding the charts, we need what is charts and what types of charts. There are three main chart types which used by the different traders. First, line chart. Second, bar chart. Third, Japanese candlesticks. This module's focus will be on the Japanese candlesticks. However, before we get to candlesticks, we will understand why we don't use the line and bar chart. The line and bar chart. The line chart is the most basic chart type and it uses only one data point to form the chart. When it comes to technical analysis, a line chart is formed by plotting a stock's closing prices or an index. A dot is placed for each closing price and a line then connects the various dots. If we are looking at 60-day data, then the line chart is formed by connecting the closing price dots for 60 days. The line chart can be plotted for various time frames, namely monthly, weekly, hourly, or etc. So, if you wish to draw a weekly line chart, you can use weekly closing price of securities and other time frames. The advantages of the line chart is its simplicity. With one glance, the trader can identify the general trend of security. However, the disadvantages of the line chart is also its simplicity. Besides giving the analyst a view on the trend, the line chart does not provide any additional detail. Plus, the line chart takes into consideration only the closing prices, ignoring the open, high, and low. So, for this reason, traders prefer not to use the line chart. Now, take a look at a bar chart. The bar chart, on the other hand, is a bit more versatile. A bar chart displays all four price variables: open, high, low, and close. A bar has three components: the central line, the left mark tick, and the right mark. So the central line, the top of the bar, indicates the highest price the security has reached. The bottom end of the bar indicates the lowest price of the same period. The left mark indicates the open and right marks indicate the close. For example, assume the OHLC data for a crude oil on a 1-hour chart as follows: open 56.517, high 56.613, low 56.463, and close 56.603. So, by tracking the open, high, low, and close, we can summarize the price action. When the market opens for trading, the first price at which a trade executes is called the opening price. The high, this represents the highest price at which market participants were willing to transact for the given day. The low, this represents the lowest level at which the market participants were willing to transact for the given day. The close price is the most important because it is the final price at which the market closed for a particular period of time. The close serves as an indicator for the inter-day strength. If the close is higher than the open, then it is considered a positive day, otherwise negative. Of course, we will deal with these in greater details as we progress through the module. So, the closing price also shows the market sentiment and serves as a reference point for the next day's trading. For these reasons, the closing price is more important than the open, high, or low prices. The open, high, low, close prices are the main data points from the technical analysis perspectives. Each of these prices has to be plotted on the chart and analyzed. Having recognized that the open, High, low, and close serve as the best way to summarize the trading action for the given period. We need a charting technique that displays this information in the most comprehensible way. And if not for a good charting techniques, charts can get quite complex. So each trading day has a 4 data point, that is the OHLT. And if we are looking at a 10-day chart, we need to visualize 40 data points. That is one day, 4 data points per day. So you can imagine how complex it would be if to visualize the 6 month or a year data. As you may have guessed, the regular chart that we generally use to like the column chart, pie chart, area chart, etc. do not work for a technical analysis. The only exception to this is a line chart. Now, candlestick chart. Regular chart don't work mainly because they display one data point at a given time. However, technical analysis requires 4 data points to be displayed at a same point. Before we jump, it is worth spending time to understand in brief the history of Japanese candlestick. As the name suggests, the candlestick originated from Japan. The earliest use of candlesticks dates back to the 18th century by a Japanese rice merchant named Homa Manesha. So the candlesticks have been in existence for a long time in Japan and are probably the oldest form of price analysis. The Western world traders were clueless about it. It is believed that sometime around 1980s, a trader named Steve Nisson accidentally discovered candlesticks and he introduced the methodology to the rest of the world. He authorized the first ever book on candlesticks titled Japanese Candlestick Charting Technique, which is still a favorite amongst many traders. Most of the candlestick patterns still retain the Japanese names, giving an oriental feel to technical analysis. Candlestick anatomy, as you look on the chart, upper wick, lower wick, upper which is high or close or higher close as shown on the screen. While in the bar chart, the open and closed prices are shown by a tick on the left side and right side of the bar respectively. However, in a candlestick, the open and closed prices are displayed by a rectangular body. In a candlestick chart, candles can be classified as a bullish or bearish candle, usually represented by a blue, green, white, and red and black candles. Needless to say, the colors can be customized to any color of your choice. The technical analysis software allow you to do this. This module has opted for the green and red combination to represent bullish and bearish candles respectively. The candlestick like a bar chart is made of 3 components. The central real body. The real body rectangular connects the opening and closing price. Upper shadow connects the high point to the close. Lower shadow connects the low point to the open. In candlestick pattern, in what to expect. The candlesticks are used to identify trading patterns. Patterns in turn help the technical analyst to set up a trade. The patterns are formed by grouping 2 or more candles in a certain sequence. However, sometimes powerful trading signals can be identified by just a single candlestick pattern. Hence, candlestick can be broken down into single candlestick pattern and multiple candlestick pattern. That is green marboju and red marboju, bullish or bearish, which are used to identify trading patterns. Patterns in turn help the technical analyst to set up a trade. The patterns are formed by grouping 2 or more candles in a certain sequence. However, sometimes powerful trading signals can be identified by just a single candlestick pattern. Marboju, doji, spinning tops, pepper umbrella, and shooting star. Few assumptions specific to candlesticks. Before we jump in and start learning about the pattern, there are few more assumptions that we need to keep in mind. These assumptions are specific to candlesticks. Do pay a lot of attention to these assumptions as we will keep referring back to these assumptions quite often later. Sorry. At this stage, these assumptions may not be obvious to you. However, I explain them in a greater detail as and when we proceed. However, do keep these assumptions in the back of your mind. By strengthen cell weakness. Second, be flexible with patterns. Third, look for a prior trend. Let these points discuss in detail. By strength and cell weakness. Strength is represented by a bullish candle and weakness by a bearish candle. Hence, whenever you are buying, ensure it is a blue candle day, and whenever you are selling, ensure it is a red candle day. Next, be flexible with patterns. While the textbook definition of a pattern could state certain criteria, there could be minor variation to the pattern owing to market conditions. So, one needs to be a bit flexible. However, one needs to be flexible within limits, and hence it is always required to quantity and flexibility. Next, look for a prior trend. If you are looking to a bullish pattern, the prior trend should be bearish, and likewise. If you are looking for a bearish pattern, the prior trend should be bullish. So friends, that's it for the day. Thank you for watching. See you in the next video. Mention your queries in the comment box. Thank you. Bye bye. Take care.